What's up everybody, Nate here, and something huge is about to happen to the housing market. Last week we talked about how mortgage interest rates were starting to drop all throughout the United States. This was highly linked to inflation. Inflation actually came down by around 0.5% in October. It now sits at around 7.7%, but the whole idea with mortgage interest rates coming down meant that, well, millions of people would suddenly be able to get a mortgage. Prices are coming down and so are mortgage interest rates, so now people would be driven back into the housing market. Demand would go up, but the problem was we did not see that. Mortgage interest rates did come down at their fastest single day pace in over a decade. This was the biggest drop since 2009, and like I said, we expected a whole bunch of new demand to flood into the housing market. But that's not all. A week later, mortgage interest rates came down again. They went back down and hovered around the 6% mark for a few days. Again, we were expecting more buyers to be pumped into the housing market, expecting this to be a good time to buy a home. Except for we didn't. Buyers still remained flatlined in the housing market. We didn't really see any new activity despite mortgage interest rates coming down. So what exactly is going on here? Mortgage interest rates coming down in the United States is a good thing for buyers, but the problem is the rates have not come down enough in order to push a lot more buyers into the market. Mortgage interest rates falling from around 7.5% down to 6% is really great, but the issue is they need to go down even further for more buyers to be able to afford a mortgage, and the reason is many Americans still can't afford a home. Home affordability is still out of control in the United States, and prices, while they have come down in a lot of markets, they aren't coming down enough for Americans to actually purchase a home. With mortgage interest rates staying pretty high still, that means that people can't get a home. So with no new buyers able to really enter the housing market right now, this might mean that the housing market has finally peaked in terms of prices. Like I mentioned before, we have seen major markets all throughout the United States dropping down their prices. In the 400 top markets all throughout the country, around 200 to 300 of them are actually lowering their prices. They are down from their 2022 peaks by around 27% right now. That means that more people can finally enter the market, but prices are still not dropping enough. So that kind of leaves two scenarios for the housing market. Are we going to see a plateau where prices basically stay at where they're at right now, or are they going to continue to dip? And that just depends on two major factors. Interest rates for the Federal Reserve have been going up all throughout 2022. I know we've talked a lot about this on this channel, but mortgage interest rates are directly affected by what the federal funds rate is. So basically how it works is when you get a mortgage, you get a mortgage through a bank or a financial institution, but the bank actually gets their money from the Federal Reserve. The Federal Reserve has an overnight borrowing rate for those banks. So that rate right now is at around 4%. So with the federal funds rate being at around 4%, that means banks and financial institutions are going to raise their interest rates a whole lot higher in order to get a pretty solid return on their loan. That's why mortgage interest rates are around 7% despite the federal funds rate being at 4%. Basically what you need to know is if the Federal Reserve continues to raise their interest rates aggressively and quickly into 2023, then that could mean that banks make it a whole lot harder for people to get a mortgage here at home, and that could mean raising interest rates even more. They have to be very careful and selective with who they can actually give a mortgage to right now, because if people don't make their payments or if people aren't able to afford a mortgage, then the bank is going to have to deal with a foreclosure, and they don't want to have to do that because homes are really hard to sell right now. So that's just a bad situation for them, so they're going to avoid that by basically restricting the number of people that can get a mortgage through their interest rates. Now, because inflation is coming down, that's why we have seen mortgage interest rates go down in the United States a little bit. We won't really see them go down dramatically until inflation really starts to go down dramatically. Same with the Federal Reserve and their interest rates. The Fed has said that they are determined and they are focused on raising their interest rates in order to bring down inflation, and so far it looks like that is starting to work throughout the general economy, especially in the housing market, because like I said, the higher those rates go, the fewer people are going to be able to get a mortgage, meaning demand comes down. And when you have next to no demand in the housing market, that means prices are also going to come down. So if we are to see prices slowly start to come down or dramatically fall in the United States, that is going to be directly linked to the Federal Reserve. If they get even more aggressive into 2023 and raise their benchmark interest rates, rates up to 5% or even 6%, then that means there's going to be even less demand in the housing market. What that will do is allow supply to kind of catch up, because people are still going to need to sell their houses in certain situations, so supply will be abundant, but there's just not enough buyers, meaning that the buyers that are on the market have complete negotiating power to get that house at whatever price they want. Over the last couple of years, the seller had complete control. People were bidding on houses and getting into bidding wars because there were so few houses on the market. There was so many people that wanted a home, but there wasn't enough supply in order to meet demand. So that meant that there was huge bidding wars, and people were buying houses for sometimes $20 to $50 and maybe even $100,000 plus above asking. That sent values for all the homes around them through the roof, and prices for everything in the housing market followed suit. That was at a time when interest rates were at 0%. They were at 0% from basically March of 2020 until March of 2022. That's really when we started to see a grinding halt in the housing market. So now, depending on how much higher and when those rates go up, that will determine what exactly happens next with the housing market in terms of prices. And of course, if we see the Federal Reserve actually reverse some of their policies, turn on the money printer, and lower their benchmark interest rates, then that could mean the housing market goes right back up, because now these banks and financial institutions won't have as high of a rate to borrow their money, so they don't need to charge you as high of an interest when you get a mortgage. So that will mean that many more Americans are able to afford a mortgage, but it will also probably mean that housing prices go up. I don't really see that in the future because inflation is still really, really high. So I don't anticipate the Federal Reserve lowering their benchmark interest rates anytime soon. The only thing that would cause them to do that is if we have a really bad recession, right? If there's lots of unemployment and spending is at an all-time low, then this would be a big problem for our economy, and the Federal Reserve would have to do something with their monetary policy. But we're not quite at that point just yet, meaning that they're most likely going to continue to raise their interest rates, albeit they might start raising their rates slower in the future. Now, the other situation is, what if the housing market actually plateaus and stays at this peak? Well, again, that's going to depend on a variety of different factors. Right now, you have demand that's basically in the gutter, right? You don't have enough people in order to support the market and what the prices are right now, which means prices need to come down to a realistic level where people can actually afford to buy a home again. But the other issue that we're seeing is sellers not putting their house on the market enough. We definitely have a housing drought in terms of supply. So with supply not really going up either at a really fast rate, that means everything is kind of in an equilibrium. You have really low demand and really low supply. So there's just not enough buyers in the market, and then there's also not enough supply either. So in order for prices to actually plateau or possibly even go up, you're going to have a whole lot more demand and a whole lot less of supply. Or like I said, for them to actually plateau and stay right around where they're at, that means that supply and demand have to be somewhat equal. But the problem is they are not somewhat equal. Demand is rapidly coming down every single week, but we're also not seeing supply rapidly going up. People, yes, are putting their houses on the market, but that's at pretty much a normal rate. It's definitely not at the same rate that people were buying homes over the last couple of years, which means prices can't dramatically fall until we have an excess or a glut of supply in the housing market. And this is where we have to pay attention to the broader economy and the market here, because the only thing that could really cause an explosion of supply in the housing market is if millions of Americans are suddenly unable to afford their home. If Americans can't afford their home, then that means a few things are happening. That means wages and salaries are not keeping up with what the current housing market values are. As the value of a home goes up, that means the expenses for a home are also starting to rise. You have taxes that go up every single year, and you also have insurance that goes up every single year, and those things can cost Americans hundreds of extra dollars every single month. Not to mention people who have an adjustable interest rate. An adjustable interest rate is going to go up and down depending on what the Federal Reserve does with their interest rate policies. So if those things suddenly start to go way up, your taxes go up, your insurance go up, and the interest rate that you have on your adjustable rate mortgage suddenly starts to go up for millions of people, now there's going to be a lot of Americans that can't afford their home anymore. So they're forced to sell. Or if they stay in their home and they try to just ride out the wave, well, then they might end up going into foreclosure, which might force that house to come on the market. If we see a wave of foreclosures into 2023, then that could actually mean prices go down really, really quickly, because when the banks get these houses back as collateral for that mortgage, they want to try to get rid of that house. It's not something that they just want to hold on to. They want to sell it, and they usually take a big loss on that, making it lose a ton of value. And if a lot of houses in an area suddenly lose a lot of value, now everything is going to come down. The other thing you have to pay attention to is unemployment. Now, unemployment from September to October went up by around 0.2%. That's not a whole lot, but it is hundreds of thousands of jobs that are being lost. Right now, we're seeing mostly tech startups and tech companies in general lay off employees. And the reason being is because these tech companies don't have a whole lot of profit, and they use a lot of investor money in order to grow their business very, very quickly. But with the Federal Reserve raising their interest rates, that means investors can't get a hold of this capital either as easily, for the same reason your bank has to raise its interest rates. They want to see a return on their money. Investors that want to give out their money now have to see a return on that money of over 4%, and that's going to be very risky and rare in this economy. So businesses are starting to shrink. They're trying to survive by cutting costs, and that usually means people. How a lot of people are losing their jobs. If they bought a house over the last couple of years, they're now forced to sell in a market where interest rates are really high and housing prices are basically unaffordable. And around 37% of Americans cannot afford their rent as of now. So if you have even more people enter the renters market, that's going to be a serious problem. Now, what is the likelihood of all of that happening? Well, it really just depends again on the Federal Reserve and of course our broader economy. If businesses have a lot of money to give and they're still able to hire people and people are still spending money, then this really won't be that big of an issue. So right now, consumer confidence is pretty decent, and we also have people continuing to spend money both on home improvements and in groceries. So that means that Americans are spending money because they have money, and that means the housing market can also keep up with its current level of demand. And it'll also mean that we won't see millions of people selling their house all at once. Not to mention, these sellers don't want to sell because they have tons of equity in their house, equity that was earned for basically doing nothing because the housing market exploded. So they want to stay and ride out any wave that's happening right now. So the bottom line here is this: mortgage interest rates have started to come down, but they're gonna have to get a whole lot lower in order for people to afford houses again. As those interest rates come down, more than likely you're going to see prices come down too, and eventually more people will enter the housing market. But until that happens, demand is going to continue to get sucked out. Supply is going to stay right where it's at because there's really not many other economic factors going on to cause people to sell their house all at once, meaning demand is just going to continue to get lower and lower and lower, meaning that the likely scenario for 2023 is that prices are not going to dramatically fall, but they will slowly start to drop all throughout the United States. That does mean that the housing market as of this point has finally peaked in prices, and now we are starting to see everything flip once again. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.